Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Has you ever wished you had a shortcut, maybe, to understanding a really complex market?
Yeah.
You know, finding those hidden gems of insight without getting totally bogged down in all the noise? Well, that's exactly the mission here on The Deep Dive. Today, we're taking a close look at a fascinating corner of the financial world, the lower middle market within direct lending. And we're focusing specifically on the financial services sector. Our insights today are pretty much custom-tailored for you, drawn directly from the expertise shared by Jason Schryver and Clayton Bruce. They're managing directors at Crescent Direct Lending, which is part of Crescent Capital Group LP, a really leading specialist with a remarkable track record in corporate credit.
That's right. And this isn't just, a technical discussion. It's really about understanding how deep specialized knowledge can truly differentiate, how it can create real value in a specific market segment. We'll be extracting those crucial nuggets of knowledge about what makes this area attractive, resilient, and frankly, pretty distinct.
Okay, let's unpack this then. What exactly defines the lower middle market in direct lending, and why is it drawing so much attention now?
Well, it's interesting. The lower middle market, it stands out mainly because it generally has fewer market participants compared to the upper market segments. So, on one level, that makes it less competitive.
Less competitive, okay.
But the backdrop also means it can involve less traditional transaction processes, maybe a bit more bespoke. And here's the paradox. There's actually a larger universe of private equity sponsors competing for deal flow in this very space.
A larger universe of PE sponsors.
Yeah. Think of it like a really active hunting ground for PE, but maybe with fewer of the really big lenders playing there traditionally. They need capital, so demand for financing is strong.
Got it. So high demand for capital, but maybe fewer financing options, or at least different ones. Now, here's where it gets really interesting. You mentioned specialization. Our sources emphasize that a sector focus, particularly in financial services, is a significant differentiator here. Why this specific sector? What makes it so attractive?
Well, look, a dedicated sector focus, especially one built on, decades of experience, it's not just a nice-to-have competitive advantage. It's actually a valuable offering to the private equity sponsors. These sponsors, they need reliable financing partners who bring not just capital, but also that demonstrated experience in navigating some pretty nuanced transactions.
So it's about trust and deep understanding, not just the money.
Precisely. They need partners who can grow with them, who understand the complex structures.
Can you maybe give us a glimpse into how that deep understanding was built, perhaps through the experiences of Jason Schryver and Clayton Bruce at Crescent?
Absolutely. Their stories really illustrate this point well. Jason Schryver, for instance. Early in his career, he worked on transactions in the financial services space. And this was during a period when both the financial services market and the broader lower middle market direct lending were frankly far less developed than today.
So kind of the early days.
Very much so. He witnessed what he calls the first wave of early PE investment in subsectors like insurance distribution and wealth management. These were small deals back then. But his direct experience during the 2008-2009 Great Financial Crisis, the GFC, that provided incredibly deep understanding. Their financial services portfolio performed, and I'm quoting here, remarkably well through that chaos.
Wow, remarkably well during the GFC. That's saying something.
It absolutely is. It really validated their focus on this market, gave him this rare perspective spanning almost 20 years.
That's powerful validation. What about Clayton Bruce? Did he have a similar path?
Similar outcome, different path. He started as a generalist, actually. But he found himself gravitating towards financial services, partly due to his interest in risk and financial markets. And like Jason, he observed the resilience of these financial services companies during the GFC.
Another GFC observation.
Exactly. It led him to really appreciate their quality of their credit characteristics, so he did this subsequent deep dive into the industry's subsectors. And that led him to conclude that this sector offered a chance to, as he put it, generate alpha for our investors. Real outperformance potential.
Generate alpha. So these aha moments during serious volatility really solidified the sector's appeal for them. It wasn't just theory.
Not at all. It was proven in the toughest conditions. That resilience, that ability to perform when other sectors struggled, that's incredibly attractive from a credit perspective.
It makes perfect sense. But, financial services can still sound quite broad. So what does that actually encompass for a direct lender like Crescent? How much diversity is really within that umbrella?
That's a great point. It can sound monolithic, but it isn't. Their team casts a fairly wide net in portfolio construction within financial services precisely because it's so diverse. Key markets where they've historically been active include insurance distribution, that's retail brokers, wholesale brokers, managing general agencies or MGAs, also asset and wealth management, various insurance services, third-party administration, professional services, PEOs, professional employer organizations, payments, and warranty providers. It's quite a list.
Okay, that's already more specific.
But here's the crucial thing, and it's often overlooked. The level of underlying diversity within those main classifications, that's where the deep knowledge really pays off.
Okay, give me an example.
Sure. Take insurance distribution. A retail broker focusing on smaller commercial customers is fundamentally different from, say, a multi-line MGA platform focused on specialty insurance. They have different revenue models, different end clients, different relationships with insurance carriers, totally different dynamics.
Right, not all brokers are the same.
Not even close. And similarly, within insurance services, think about businesses focusing on claims management versus cost containment or subrogation or fraud management. Each serves unique customer segments that behave differently. So having that extensive historical activity across all these different segments lets experienced lenders build genuinely diversified portfolios.
So that nuanced understanding is precisely what gives them a competitive edge. It's not just knowing the label, but knowing the ingredients.
Exactly. It's knowing the ecosystem from the inside out.
Okay, let's transition to the operational benefits then. How does this deep understanding of financial services translate into, say, a better underwriting process and stronger partnerships with PE sponsors?
Right, it translates very directly. First off, efficiency. That sector focus enables a more targeted diligence framework. It means a more efficient diligence process.
Less time wasted getting up to speed.
Precisely. Clients value that hugely. They don't need to explain the market basics. This creates a speed of execution competitive advantage, which is critical in deal making. Second, many financial services companies just have really attractive Credit 101 attributes. Things like
what specifically?
high recurring revenue, strong margins, often variable cost structures, good free cash flow conversion, low capital intensity, fundamentals. And crucially, their demand drivers are often less correlated or sometimes entirely uncorrelated to the broader macroeconomic cycles.
So they're more insulated from general economic downturns.
In many cases, yes, which is obviously very appealing for lenders.
Makes sense. What else?
Third, there's a robust M&A market in this sector. Lots of consolidation, lots of activity. This means good future deal flow, and it often results in low loan-to-value ratios, LTVs, at the close of a deal.
Lower risk for the lender.
Right. It provides a margin of safety and often what we call a strong second way out, another path to getting repaid, besides just the company performing perfectly. And fourth, underwriting these businesses does require unique layers of diligence. This is where specialists shine.
What kind of unique layers?
Things like evaluating actuarial work, even if the company doesn't take direct insurance risk, or reviewing restrictive covenants in employee contracts, which can be crucial in service businesses. Assessing regulatory capital at broker-dealers, dealing with sometimes imperfect collateral packages. Maybe the value is in licenses or relationships, not hard assets. Or understanding specific EBITDA adjustments common in this sector.
Things a generalist might miss or get bogged down by.
Exactly. Experienced lenders address these upfront, avoiding friction. And this deep understanding allows them to scale their initial investment size over time. Many of these deals are built around an aggressive M&A plan, a buy and build strategy. Lenders look at the lifetime value of the relationship.
Thinking long term.
Yes. And PE sponsors really value lenders that can speak their language, who get the industry jargon and the strategic goals.
So it makes the lender more than just a source of capital. They become almost a A consultative partner.
That's a great way to put it. A true consultative partner who understands the specific path they're on.
Okay, but no investment strategy is completely risk-free. Where does this specialized approach lead to maybe extra caution or even outright avoidance of certain areas?
Absolutely. Risk management is key. Generally, experienced lenders in this space, like Crescent, try to avoid businesses or markets with significant direct catastrophe exposure. Too unpredictable.
Makes sense. What else?
They're also more cautious around businesses that take direct underwriting risk, like primary insurance carriers. The diligence there is incredibly deep and time-consuming.
So focus more on the service and distribution side.
Often, yes. They've also historically avoided areas like consumer financing, especially subprime. Also, industries with significant regulatory overhang, that stroke of the pen risk, where one rule change can upend everything. And finally, they tend to be cautious with financial services businesses that have more cyclical predispositions, like heavy direct real estate exposure.
So a clear set of guardrails based on experience.
Definitely.
On the flip side then, where do they see the biggest growth opportunities moving forward?
Well, the traditional M&A heavy segments like insurance distribution and wealth management, they continue to offer really robust acquisition opportunities. It's fascinating. The addressable market just seems to have this remarkable and demonstrated way of refilling itself. Always new opportunities emerging.
Self-replenishing almost.
Kind of, yeah. And the insurance space specifically is benefiting from this record-long period of rising premiums, driven partly by, sadly, high-dollar natural disasters, but also new risks like cyber attacks. This keeps attracting capital and driving activity.
And beyond insurance.
Professional services, think accounting firms, actuarial consultants. That's been a real hotbed of PE activity and is expected to keep growing. Businesses keep outsourcing. And looking further out, you have to consider AI, right?
Of course. Disruption or opportunity?
Both, probably. There might be isolated areas of potential disruption, but over a longer time horizon, certain areas like high-volume claims processing or fraud detection could actually be major beneficiaries of AI, using it to get smarter and more efficient.
Interesting. So it's not necessarily a threat everywhere?
Not at all. It could be a powerful enhancement tool in many parts of financial services.
Okay, great. So let's wrap things up by looking at the bigger picture. How does having an allocation to this specific sector, financial services, in the lower middle market, how does that affect a broader direct lending portfolio? Especially thinking about the current macro environment.
Yeah, that's a key question for investors. One of the biggest benefits is that low correlation we talked about earlier. Many financial services transactions are often much less correlated or even fully uncorrelated to the broader economy. Crescent's experience, spanning decades, shows that many headline macro factors, COVID, energy prices, tariffs, geopolitics, even big interest rate moves, have had a fairly muted impact on the core performance of these businesses.
That's pretty significant resilience.
It really is, and sometimes macro trends can even be helpful. Take the recent inflation spike. For some subsegments like insurance distribution where revenue is tied to premiums.
Higher premiums mean higher revenue.
Exactly. It was actually a tailwind for those business models.
Yeah.
Increases in asset values or social inflation could be positive drivers.
Fascinating. So how does that play out in a portfolio context?
Well, having a healthy allocation to financial services like this actively serves to reduce overall portfolio beta.
Meaning it makes the whole portfolio less volatile, less sensitive to big market swings.
Precisely. It helps in smoothing out inherent exposure to more cyclical end markets that might be elsewhere in the portfolio.
Like a stabilizing influence.
It's a very valuable one. Even in wealth management, where you might think revenue is tied directly to market ups and downs, the correlation between asset values and actual revenue levels is much lower than would initially be expected. Revenue tends to be less volatile than the market itself.
Why is that?
Partly because during market dislocations, nervous investors often seek more advice, leading to increases in asset inflows. And highly variable compensation models for advisors act as a relief valve for firms, helping maintain profitability.
So multiple layers of resilience there, too.
Yes. And the bottom line is this sector just has a strong record of covenant compliance across economic cycles. It really underscores the stability and defensive characteristics.
So to sum it up, this sector offers not just, unique resilience on its own, but also provides really valuable diversification benefits for investors in a broader portfolio.
That's exactly right. It's about building stability through focused expertise.
Well, we've really taken a deep dive today. We've uncovered why the lower middle market, specifically within financial services, presents such compelling and stable opportunities for direct lenders. We've looked at its less crowded lending landscape, the really surprising resilience of these businesses through tough times, and the absolutely crucial role that deep, specialized knowledge plays.
Yeah, and what's really fascinating to me is how that decades of focused experience, like we see from the team at Crescent Capital, how it transforms really complex information into clear, actionable advantages. It just highlights that understanding the nuances, the why it matters, that's paramount if you want to navigate and really succeed in these specialized markets.
So, thinking about this, what does it all mean for you, our listener? As you consider the landscape of investment and knowledge out there, how might this deep dive inspire you? Maybe it encourages you to look for similar aha moments or those specialized niches in your own areas of interest. Maybe there are overlooked segments you could explore. We definitely encourage you to keep digging deeper into the topics that truly matter to you. That's often where the real insights are hiding. A huge thank you is due to Jason Schryver and Clayton Bruce for the insights that really made this deep dive possible. And of course, a special acknowledgement to Crescent Capital Group LP for their contributions to the source material we explored today. Thank you for joining us for this deep dive.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.